Really, geopolitics, lots of risk is around and plays a large part in portfolio construction. But we're seeing throughout the last year or so what geopolitical risk can do to investment markets. The risk of geopolitical risk, its occurrence, is one thing that is very difficult to measure, but the level of impact on your portfolio is another thought. When you're looking at all those factors, as I mentioned, global growth has downshifted. Inflation is at play, and you've got central banks trying to control their own inflation within their regions. But if you don't have that growth backdrop supporting each economy, then perhaps these geopolitical risks are going to be much more of a factor going forward for individual growth of economies.
The risk appetite of the market is via three different inputs there. So we're looking at equity market volatility. So we look at the volatility of different market indices across developed and emerging markets. We're looking at currency volatility. So we're looking at major currency pairs that are traded globally and the volatility there. And we're looking at the global credit spreads of risky debt, so emerging market debt and high yield debt. And I guess the wash up of all of this is really to give us an idea of investor risk appetite and investor risk aversion. Obviously, if there's high levels of volatility, credit spreads are widening, then there's an indication that there is risk aversion out there in the marketplace, and growth assets may be on the nose in terms of our tactical positioning. Excuse me. And vice versa, if we do have low levels of volatility and contracting spreads, then risk assets are somewhere that we may look to move.
To the extent that we think about geopolitical risk, we want to be very clear about the difference between geopolitical events, which tend to be sort of short-term and isolated in nature, and geopolitical shifts, which tend to be long-term and more impactful. And the reason we want to distinguish between those two is primarily as an asset allocator. We are more interested in long-term and the medium-term impacts on markets, and less so on the short-term, and our ability to actually, we also need to be humble about our ability to actually identify and kind of add value through that sort of short-term dynamics. I think just to clarify the point about predicting, it was really more around those short-term events, outcomes of elections, likelihood of war, even in Russia invading Ukraine wasn't sort of widely anticipated until it happened. But I do think that the longer term, the points I talked about, so the China-US tensions, that how it evolves is it's going to be slow moving, and I think it's less likely, not impossible, but less likely to be kind of an event around that, and it's more going to be a thematic shift. And you're seeing even recently further sort of crackdowns in technology sharing or provision between the US and China as sort of an example of that. So I think that those longer themes are becoming a little bit more predictable, and that's the point around them. Therefore, us having more confidence in reflecting that in our SAA and DAA views versus, say for example, a harebrained political decision by the new UK Prime Minister, impossible to predict that was going to happen, and outcome was pretty predictable if you knew it, but you didn't know it was going to happen, so we sort of looked through that.
Do you go with the argument that supply chain redundancy means a greater claim on raw material inputs, and therefore prefer to allocate to a value manager that gives you your enduring factor loading, but comes with a heavy sectoral allocation toward those kind of stocks and sectors that would benefit if those views ultimately prove correct? So, for example, a manager like Alan Gray that takes a very big swing might be preferable in that context to, say, a dimensional, where you're going to get your heavy value factor loading exposure, but it's going to be more evenly distributed across the sectors. So those kinds of consideration come to mind if you have a concrete view about what are the macroeconomic ramifications of deglobalisation and of geopolitics. But that is a tagline that we use constantly with clients, and are using it more than ever right now. Spread the capital far and wide across geographies, across styles, across sectors, making sure that there's no hero trades in the portfolio for what is essentially an unknowable political regional dynamic.
Talking about geopolitics and the impact on food and energy security, Australia's in a pretty attractive relative position. The lucky country again, where we do have exposure to commodity exports, so fairly resilient. And Jay talked earlier just about pursuing those sorts of businesses that have strong cash flows, that are regulated, ability to pass through inflation. Definitely, we do have a pretty high quality bond market. So just thinking about diversification, I think fixed income is a relevant and opportune investment.